I am going to have people jump in later if they want to with questions. So I want to mention that. But I'm just going to start and say hello, everybody. Welcome and thank you for joining us. I am Hillary of Bright Sound Investments, a private real estate equity firm. And we invest in multifamily and senior living. And I think we're all going to learn a lot tonight from our incredible guest about investing smartly, protecting your capital, maybe most importantly. So I want to give you a little bit about Vessi Kapoulian. Vessi is the founder of Dream, Believe, Achieve Capital Group, a Los Angeles-based real estate investment firm focused on multifamily investments and assets. She was born and raised in Bulgaria behind the Iron Curtain. Vessi earned a full academic scholarship to study in the United States, leveraging education as her path to opportunity. And after initially pursuing the traditional corporate path, a series of life events prompted her to reevaluate her definition of success and ultimately pivot into real estate investing. Before becoming a full-time investor, Vessi spent years in commercial lending, where she managed and underwrote hundreds of millions of dollars in real estate loans. And that experience shaped her disciplined, risk-first approach to underwriting and capital allocation, and which is a perspective that she now brings to every investment decision. And today, she manages approximately $80 million in multifamily assets across Georgia, Tennessee, and Florida, and also invests passively in select opportunities. She is the best-selling author of Mastering Multifamily Underwriting. Hold on, I have it, guys. I have it right here.
Oh, thank you.
Amazing, amazing resource. And she's a frequent speaker on risk management, underwriting discipline, and passive investment strategy. I love this. Her mission is simple: help high achieving professionals and sophisticated investors protect the downside, build durable passive income, and create long term optionality for their families. So, wow, Vessi, you're amazing. Welcome. You have underwritten over 1,000 deals. You've managed $1 billion credit portfolio. In today's market, higher interest rates, tighter lending, what are some of the biggest mistakes you see investors making when they evaluate multifamily deals?
Well, first of all, thank you for the warm welcome, Hillary, and for the very kind and detailed introduction. It's a pleasure to be here, and I very much look forward to an insightful discussion. So, we live in a very, very interesting times, very dynamic times, right? And that's actually one of the things that I love about real estate. It's not just the real estate, but it's important to have broader awareness of both the macro picture and the global picture. And so to answer your question directly, what are some of the maybe pitfalls or or areas of opportunity, let's just call them, that I see investors make when they make investment decision? I'll tell you, it doesn't start with the numbers. That's actually the easiest part, and I can definitely talk about the numbers. But it's a people's first business. So usually where I spend a lot of my time or most of my time is building relationship with the right strategic partners and really vetting the operator. And I can dive deeper into what exactly that means. Vetting the operator, and because ultimately when you go into these investments, and specifically I focus on cash flowing apartments, so just want to give my disclaimer out there. There's obviously a lot of ways one can get involved in real estate and commercial real estate in particular. But you're getting into these deals that are 5 to 7 year marriages effectively. So it's important to understand who the people are, how they operate. It's not good or bad. It's just, do you align, right? Do they align with you? Secondarily is the market, and I can do a deeper dive into what that means and what I look for. But very often, I'd like to say that the market shapes the inputs that drive the outputs, right, for the financial models and forecasting, and therefore the pro forma returns. They really set the picture for where really the downside risk lies, and perhaps where there may be some optimism baked into into the assumptions and projections that I see very often. And the last piece is the deal. That's actually easy because it's black and white. That's the numbers, it's the structure of the deal. So going through the offering documents, specifically the PPM, the operating agreement, and really understanding not only how that works, but again, trying to answer the question, does this risk profile align with my own risk tolerance? And does this investment align with my own goals? And of course, the answer would be different for everyone because we all have different goals, objectives, and buy box and risk tolerance. So it's important to take a step back and really have clarity on those key questions. What am I looking to do and why? To stay focused and not get distracted by either shiny objects or social media fluff and maybe over marketing. So pause for a moment and happy to dive into each of these deeper if you'd like.
Yeah, that was awesome. I don't know if we want to take it from like, what do you do first and what do you
Okay.
recommend people do?
Mm-hmm.
Or we could go the other way, which is like, what are the the first red flags that you
The
look
first
for?
red
I
flag.
guess they're kind of intertwined.
Okay, so I'll probably let me just I can walk you through my process, right? So I have very specific criteria. So when I get a bit an offering deck, or also known as pitch deck, I don't like the word pitch deck, but let's just use that because it's
It has a
very
lot of
common.
names actually. Offering memo,
Yes.
yeah, slide deck, yep.
So when I look at it, when I open that up, what I'm looking for is, does the deal align, right? So in that case, so if I see a property that's maybe a little bit older, aluminum wiring, something with a lot of deferred maintenance, uh, it's the I guess the pink flag is sort of at the back of my mind. That's not necessarily a red flag, but I'm already thinking, okay, there better be a lot of buffers and other mitigates in this deal because I know I'm gonna be getting my hands pretty dirty, not in a bad way, but there will be a lot of work involved. Of course, location, right? I want to be in business friendly, landlord friendly states. And one of the first things I do is literally takes a couple of minutes, but I also developed a GPT that comes with the book. Actually, it's one of the book resources where people can do a very quick preliminary market research. And I want to know if the very basic KPIs of the market are there: growing population, diverse jobs, crime activity. So just the other day, for example, I saw an offering for a property in Florida, and it was in that Space Coast area, which I happen to be familiar with. And it can be a rough area. It's a very block by block specific. So my antennas were already up. Sure enough, I look up the property, and there were like two shootings nearby, like within a mile. So for me, that's not really exciting. For some people, it's okay to keep the excitement, but that for me is an automatic no, because I if I don't feel comfortable being in that area, then property managers or other key team members probably wouldn't be there, let alone residents. So these are some of the first checks that I look at, and then I go straight into the numbers because for me, I have a few non-negotiables, and a lot of that is predicated based on my view of the current markets, my view of the future markets, and then my own risk tolerance. So one of my first non-negotiables is cap rate compression, exit cap rate compression. I do a ton of reading and I'm curious by nature. So I have a general understanding of where markets are, where class A, B, C properties are trading in primary versus secondary versus tertiary markets. So I can make a pretty educated guess if for whatever reason the public data is not available, or I don't have the CoStar underwriting report on what the entry cap rate is, meaning what the current market cap rate is. But when I see compression, my hairs go up, and it's like you can't. If that's how the sponsor thinks, and again, that may very well be a function of their personal outlook, and if they believe cap rates will compress, that's how they're going to underwrite. It's just neither here nor there. It's just different. Um, but that's just not something I would negotiate. Uh-huh.
Can you explain, explain it like we're 12 or something, what a cap rate is?
You can think of the cap rate if you are hearing the concept for the first time as the rate of return that you would receive on the property if you bought it all cash. In other words, if there was no loan involved. And typically how it's calculated is the operating profit, which is known as net operating income of the property, then divided by the value of the property. Typically that would be the purchase price. So depending on where properties are trading at, that's where the market would be. And so when I reference market cap rate, that's what I'm looking at. So a lot of the big brokerage houses, right, and or databases like CoStar, RealPage, Yardi, they have that type of information. So are a wonderful source where you can find that. Um, so that's one of the first things, right? And these things are typically in the offering memo, right? And if the sponsor care to include the information, not all of them do, but you if the deal seems interesting enough, you can always request the underwrite. And then rent and rent growth assumptions. So again, you can do a very quick search, doesn't take more than a few minutes to figure out what the or even do a quick look through some of the public sources to see where current rents are trending, what the growth rates have been. And so there was a deal that I saw not too long ago, and on the paper it actually looks very conservative, 0% rent growth in year one. I think year two was a bit shaky, had like maybe 10% in year two, and then slowly dialing down to 4 and 3.33. So you think, oh, 3% is very conservative. But for that particular market, over the last year, rents have been declining by 2.5%, right? And so my question is, well, what are you going to do differently to stay flat if rents are declining? And naturally, or if you're assuming 0% rent growth in year one when the market is actually declining, then you'd better have some pretty robust cushions with respect to concessions, bad debt. You're likely going to have to give away like free rent, no fees and whatnot, which effectively brings you to the same net revenue number or the collected rent known as effective gross income. So, and these things, again, they just jump out at me when I look at the numbers. So cap rates and rents, these are the two variables when you start analyzing the deal that have the most potent impact on the valuation. Why cap rates? Because they're effectively an inverse multiplier when it comes to the valuation. That's really hard to find. And unfortunately, we're seeing that in the current environment, even with operators who've done an excellent job, grown NOI, but because cap rates have expanded, right, from the lows of 3, maybe 4 to the tunes of 6 or 7, depending on what asset class and which market. And nobody could have projected that, right? So really, really hard to find that multiplier effect. So while I don't know where cap rates would be a year from now, let alone 5 years from now, I personally choose not to gamble, and I prefer to assume they will at least expand a little bit. And if they don't, then that's fantastic news for me and for my investors. And then why rents? Well, because everything flows from the down from the top line, right? And if you get the base wrong, then the whole P&L is off. And not only that, if you get the not only if you get the base wrong, but if you get the growth rate wrong, then you're starting with a wrong number, and then you're compounding your error year over year over year. Again, very difficult to catch up. Once you're behind, very difficult to catch up. So that's one thing that I see. And then to the extent it's included in the offering memo, I do want to see that there is good alignment in terms of fee structure. So the other day I saw a deal, it caught my attention, right? It was a Houston deal. Offered, I think it was 67,000 a door, which I mean, seems really low relative to the market is, but it also raises the question, are you in the hood or like where is that deal that is priced so low? But anyway, I figured let me take a look. Return profile seemed reasonable. And I opened the deck and it was a 10% acquisition fee and 5% property management fee, right? And now, granted, the split thereafter was 90-10. So, but I have an issue with that, right? Because in that case, the sponsor gets compensated up front. They're taking pretty much zero risk, and all the risk is borne by the LPs. So, I absolutely want the sponsor to be well compensated. I absolutely want the sponsor to be well motivated. And in fact, I've also declined deals where I thought the margins were too thin, where they were giving away the deal for free. In that case, in the opposite case, right, there were pretty much almost no fees with 90-10 splits. And while all of that on paper seems very favorable for LPs, it leaves zero incentive for the sponsor to work on the deal, especially if challenges arise. And we both know challenges do arise. It's a business after all, so unexpected things happen.
That
So do you
sounds like that
have,
might be like the only way the deal would have worked is if they do that, they don't pay any acquisition fees up front or something.
Could
Um,
be, could be.
but
I honestly I put it away. I was like, that's enough for me. I didn't even look further. But if a deal looks interesting enough, I definitely want to dig into the underwrite. And I've shifted my stance on that. I was maybe a little bit more open to receiving that over PDF because some sponsors would decline to do that on the basis of, oh, I have a proprietary model. Um, I've shifted away from that. So unless they can provide the full unlocked Excel underwrite to me, it's a no-go. I need to see the full underwrite. I need to dig into their assumptions. I need to see how they underwrote the deal. Um, and go through everything with a fine-tooth comb because again, I'm placing not only my own capital, but that of other investors potentially. So if they're not transparent from the beginning, what confidence do I have that they'll be transparent once we are in the deal? And definitely want to go through their track record. A lot of people talk about track record, but it's also important to at least acknowledge, right, that so the 0809 crisis happened. Multifamily really didn't hit bottom until about 2010, 2011. And from 2010, 11 up to 2021, it was a ride up on the roller coaster, right? So up, up, up. So even if you operationally you were not very successful, you got bailed out by the cap rate compression. And so when I uh, receive or see the track record charts with 30% IRR, what I'm really looking for and what I ask them to share is how did their NOI perform relative to the original projections? And if they don't share that, which has happened before because I was told they were too busy, and I'm not disputing they're not busy people, but that for me is a pencils down moment. Again, I need to see the numbers, and there are plenty of deals out there. There are plenty of sponsors out there, so it's okay if I miss out on one that I feel is maybe not fully transparent. And how they communicate, like everyone has requires different level of detail. I'm a very detail oriented person. Maybe that's why I became a lender after some time. So that's in my DNA. But I like to see the reports. And at a minimum, I like to know that they are available, like the full financial statement, a balance sheet, income statement, statement of cash flow, of course, the rent roll, the general ledger, AR, AP aging. Not all of them will include it in their report package, but as long as it's available and I have access to it, that gives me comfort. Because what a lot of people also do is they invest in the deal and they kind of check out. But I would say both for active and passive investors, it's important to monitor your investment, right? For the sponsor, so they can proactively address issues when they see those issues emerge. And then for the LP, at least read the update or the executive summary provided to you by the sponsor. So if God forbid the deal is not going great, you're not waking up one day finding out, oh, I lost my money. So hopefully the sponsor is communicating that all throughout. Although I've had opposite cases where LPs close on the deal, never heard back from the sponsor until one beautiful day they got an email saying, "My congratulations, we lost the property." So these things too happen. And so how do you control for that? I mean, you really oftentimes they'll tell you what you want to hear. That's why it's good to take the time to talk to other investors, maybe other partners, ask for these sample communications, right? If the communication that you see doesn't meet your requirements, that gives you the answer right there, right? So there are no surprises post close, but take the time, don't rush. I know it's very tempting to like rush into a deal and you get bombarded with the messages of 80% full, 85% full, 91.5% full. Come on one, come on all. The sponsor is under pressure, right? Because they have a contract and their deadlines and they have to fulfill their contractual obligation. But I promise you, there is always going to be a next deal. The worst thing you can do is have remorse after you invest or not being able to sleep at night because you didn't vet or you didn't ask all the questions you thought you should ask. So sorry, I know I keep talking a lot, so let me pause for a moment because I can keep going on and on and on.
No, that's great. So transparency is a big one. And you also mentioned acquisition fee and
Mm-hmm,
splits.
mm-hmm,
I know this is a loaded question, but like, could you give us like what you see as reasonable? I know what I'm used to seeing, but I'm just
mm-hmm.
wondering from your perspective, what is not a red flag at all?
Yeah, I would say 2 to 3% of the purchase price. That's reasonable. More often than not, if it's a 2% acquisition fee, there is usually a 1% disposition fee on the back end. Um, where sometimes I have issues with that is uh, depending on how the capital waterfall is structured in situations where the deal may not be doing great. Because if the deal is failing, typically transaction fees, which the exit fee is part of, would fall into those transaction fees. So in reality, the sponsor gets paid first in those scenarios before the LPs do. So normally I wouldn't have an issue with that, but if a deal is failing, right, hopefully the sponsor steps up and says, "Hey guys, we're not going to collect this fee because we didn't perform, but instead here is to cover whatever shortfall we have, right, with your principal investment." Um, and I can definitely come back to the waterfall question. And then the other fee is asset management. That can be a tricky one, right? The typical asset management fee is about 2% of effective gross income. There was one deal where it was like 5%, but it was based on NOI, so based on the profit, which is even better because it really incentivizes the team to watch the bottom line. But what I run away from and just doesn't align with me at all is asset management fees based on the equity raised. And I see a lot more of these popping up because I understand syndicators are struggling, but that to me is an automatic no, red flag, misalignment of incentives. And just to be clear, I'm talking about single asset syndication deals, right? If you're in a fund, the asset management fees, which is typically 2%, is typically based on the capital committed to the fund. So that's not unusual when you're talking about the fund structure. What I'm referencing is a traditional single asset syndication deal where if it's based on equity raise, that's like, again, misalignment of incentives, so automatic no. And probably the third one I'll mention, that's a tricky one, is the construction management fee. I have no issue with when that is in the deal. But there need to be performance levers, right? If the operator blows through the budget or maybe doesn't deliver on time, they should not be collecting that fee because they didn't perform. But again, oftentimes the way the agreement is written is doesn't always provide clarity on how that is structured. So that would be a question to ask up front and then assess, right? Are there other buffers in the deal that make you more comfortable? And if not, then walk away if you feel the incentives are misaligned.
Yeah. So I'm noticing like the guest list here. I'm just looking at our guests and
Uh-huh.
seeing a mixture of people who actually underwrite themselves some
Mhm.
friends of ours, maybe, that we know, and so or that at least that you and I know individually. And then some people who are just purely limited partners, LPs, as you're calling them.
Mhm.
So um, there might be someone who didn't even know the term LP. You know what I
Okay.
mean? So
Okay.
I think we have all
Oh, okay.
the
Sorry, I'm
full,
going.
no, I just think we
Yeah.
have the full spectrum here.
Spectrum, yeah.
So I just wanted to like we've spoken to, I think, I think we've spoken to
Yep.
most of the spectrum, but just to take
Yep.
it to
Yep.
those people that are just getting started,
Mm-hmm.
um, maybe they've never invested, or maybe they've invested once or twice, but didn't
Mm-hmm.
really know what they're looking for. Just kind of they trust their
Mm-hmm.
sponsor. They trust the team. They got a
Mm-hmm.
good sense, and I think that's a huge part of it, obviously.
Absolutely. Mm-hmm.
Um, but what can they do? Like what if their sponsor offers them a deal and says, "Hey, we have an opportunity to invest. Take a look at our offering memo